Hi, everyone, and thank you for joining us for today's webcast, Going Beneath the Surface, Active Management in Metals and Mining ETFs, sponsored by Sprott. Today's webcast will provide one CFP, one IWI, and one CFAC credit. If you have questions on credit, please give us a call via the number on the console. We welcome and encourage your questions. You can type your questions in the Q&A box, and we'll do our best to get to as many of your questions as possible. Material, including today's presentation, have been made available for download from the Documents folder to the right of your screen. We appreciate your feedback. Please take a moment to take our brief survey that is located at the bottom of your console. We will cover quite a bit of information during today's webcast. If at any point in time you are interested in scheduling a one-on-one meeting with Sprott, please click the Confirm button in the meeting request box on your screen. Lastly, in the event you missed any part of today's webcast or simply would like to watch it again, a replay will be made available and all registrants will receive that information by email. So with that, I'd like to go ahead and turn it over to today's first speaker, Ed Coyne, Senior Managing Partner of Global Sales at Sprott. So with that, Ed, I will turn it over to you.
Thank you, Natalie, and thank you everyone for joining today's webcast. Again, my name's Ed Coyne, and I am pleased to welcome our panel of featured speakers. We have three individuals from Sprott joining us today, and the first is Steve Schofstall, Director of ETF Product Management at Sprott with over 20 years of investment experience in ETFs. Also with us is Shri Karkukar, who is a Senior Portfolio Manager at Sprott with over 15 years of experience in metals and commodities investing. And last but certainly not least, we have Justin Tolman, Senior Portfolio Manager and Economic Geologist at Sprott with over 20 years of global mining experience and an expertise in project evaluation and portfolio management. Gentlemen, thank you all for joining today's webcast. For those who aren't familiar with Sprott, we'll go into that in a moment, but before we go into that, I want to talk briefly about the outline of today's webcast. With Steve, we have asked him to speak specifically about the macro drivers in the metals markets. Then we'll turn it over to Shri to talk about gold and silver, and then Justin to talk about uranium and copper. Then we'll open up the dialogue with Shri and Justin to go specifically into digging into why active management matters in the metals and mining space. And then before we go into Q&A, I'll turn it back to Steve to talk specifically about two of our newer ETFs, the Sprott Active Metals and Mining ETF with the ticker symbol METL, and the Sprott Active Gold and Silver Miners ETF with the ticker symbol GBUG. For those that are on today's webcast who are new to Sprott, we are a global leader in precious metals and critical materials investments. We're a publicly traded company and trade on both the New York Stock Exchange and the Toronto Stock Exchange under the ticker symbol SII. Through the end of the second quarter, we have over $40 billion in assets under management, and I'm pleased to report that through the end of September, we have over $50 billion in assets under management. We offer investors a way to invest specifically in precious metals and critical materials investments through whether it's exchange-listed products, managed equities, or private strategies. So with that, I'd like to bring Steve on to get started in our webcast to talk specifically about the macro drivers in the metals markets. Steve?
Hey, thanks, Ed. So as Ed mentioned, we'll take a look at macro drivers. As we go through this, we'll focus specifically on critical materials. Justin and Shri will take some time to go through some of the specific metals that we'll touch on here, as well as gold and silver. So I think the first thing to really focus on as we look at the macro view of critical materials is there's this underlying increased demand that we're expecting to see for electricity. Estimates have that up to about 170% out through 2050. A lot of what's driving that, it really depends on what part of the globe you're in. If you're looking in developed countries, things like the growth in AI and data centers are expected to be a very significant demand driver for electricity as we move forward. Also going with that is electrification. So think things about energy transition, EVs, and as we're electrifying the grid, a lot of resources are going to be needed to not only meet the demand, but also to build out the infrastructure. When you look at developing countries, it's really about increasing the standard of living, modernizing the global economy. Countries like India, China continue to build out their economies. We're seeing that throughout many of Southeastern Asian countries, moving into Africa as well. All of these aspects of economic growth are very energy intensive, and because of that, they require significant amounts of critical materials. If we were just to focus on AI and data center growth and what that means for future electricity demand, it's not just as easy as saying that we need more electricity, so thereby we need more critical materials. There's a whole infrastructure that has to be built out. And along with that, not only does the infrastructure have to be built out, but we have to also have electricity to actually power this new infrastructure. So increasingly, we're seeing these hyperscalers are turning not only to nuclear energy, which is starting to be favored because of its reliable baseload power. We're seeing firms like Amazon and Meta and Microsoft investing directly in nuclear energy companies, and investing in next-gen reactors or companies that are going to produce next-gen reactors. But a lot of these companies also have their own clean energy mandates and are investing in things like wind and solar, which are also very metal intensive. One thing that really ties everything together would be copper. It's the second most conductible metal on Earth behind silver, which is far more expensive. It can also operate at a much lower heat point, so a much cooler point, which is very useful in the large data centers that we see with AI. One of the largest costs that they have is around running all the complex computing applications and keeping everything cool. So cooling costs make up a very significant percentage of their overall costs, which is why copper's being used more and more there. When we look at copper specifically and how that figures into data centers, we're expecting to see that over 2% of global copper supply and over 3% of rare earths out through 2030 will be utilized by AI data centers. So in the news in recent times, particularly rare earths has become a kind of a flashpoint and a hot topic. And we see that with the ongoing trade friction that we have with China and what's going on there. That really moves us into the next aspect beyond electricity, and securing energy and critical materials are now very much a national security priority, not only for the United States, but many Western governments. Because of this, we're seeing an increased emphasis being placed on either within the United States borders or in a term known as friendshoring, where we're looking also to our allies, is to secure supply chains as it relates to things like copper, rare earths, uranium, all of these aspects that are starting to become so heavily dependent on our future economic growth and energy security. We'll look on the next slide here just to show how much China really does dominate a lot of what we're seeing as it relates to a lot of the production and the refining capability of these critical materials. We're seeing a lot of things happening within the last couple of months as it relates to energy security. The first being is a really big move that we've seen that we haven't really seen in the United States, and to a large extent, is that we're starting to see the U.S. government, whether it's through grants that convert to equities or other means, starting to take ownership in some of these companies. MP Materials, which is a rare earth producer, Lithium Americas, Trilogy Metals are all companies that are bringing, whether it's copper or lithium or rare earths, into production. We're seeing the government take about a 10% stake in each one of these companies. But just within the last week, we've had a flurry of news really come online about not only from a government perspective how they're looking to invest in the supply chain, but also from a private perspective. Just last week, JP Morgan announced they're going to make $1.5 trillion available over the next 10 years to help finance and facilitate, and in some cases invest directly in industries that are critical to economic security for the U.S. They have a fairly robust plan as to which areas this includes. They specifically mentioned critical materials, mining and processing, as well as nuclear energy. Also last week, the Pentagon mentioned that they're looking to invest up to $1 billion in critical materials stockpile. This is similar to news that we've seen come out of Australia, where they're also looking to make their own stockpile and allowing foreign companies, or countries rather, to invest in that stockpile. And just yesterday, the United States and Australia have reached an agreement to help build out not only rare earths and the mining and refining capacity there, but also other critical materials within Australia. We also see some unusual things that we're not really accustomed to in the United States, where last week the Treasury Secretary announced that he could foresee an area where the administration will set some price floors as it relates to some of these strategic industries. That's to help incentivize investment in the United States. And one last aspect to this is also last week, the Trump administration announced plans where it's seeking to invest in critical materials, not only the mining, but also the refining capabilities throughout Africa. This is coming through the U.S. International Development Finance Corp, which is really tasked with looking to secure critical materials. So that's a high-level overview, and I'll kick it back to you. Thank you.
Thank you, Steve. And I'd now like to turn it over to Shri to focus on both gold and silver. Shri?
Yeah, thanks, Ed. Let's take a look at slide number 11 here. The slide will likely surprise many of you listening, because it certainly surprised me when I first came across it earlier in the year. It shows that gold hasn't just held its value through the 21st century, it's actually outperformed the S&P 500, the global bond index, the US dollar, and even the NASDAQ. And in a world where we find ourselves constantly chasing the next trade, I think gold just reminds us that sometimes stability is the smartest growth strategy. Slide number 12 is a slightly different, but also a very compelling way of looking at gold. Because in the time that it took for the above ground stockpiles of gold to just over double, this is between 1980 and 2024, the US government managed to increase its outstanding debt by 42 times. So the gold supply is constrained. It has been growing around 1.8% annually, whereas the US government debt supply seems to be unconstrained. And that just seems to put a bit of a highlight as to why gold is performing as well as it is right now. Now let's look at what's happening with the gold mining industry. A couple of major trends stand out. The graph on the left is rather interesting. It shows that despite exploration budgets increasing, the amount of major gold discoveries has been trending lower. To state the obvious, easily accessible high-grade gold deposits have mostly been mined out. At Sprott, we monitor the mining industry closely, and we're finding out that gold is being mined at lower and lower grades, and the underground gold mines are going ever deeper every year. The chart on the right is also worth paying attention to. It shows that despite rising gold prices, the industry has not been able to respond with higher mined output. Gold miners, both large and small, are always scrambling to maintain production. And as a result, the overall gold production has not really responded materially to the upside, despite gold trading near an all-time high. Let's spend a little bit of time looking at gold equities. Gold stocks tend to outperform the bullion during bull markets. For instance, from 2001 to 2010, the price of gold rose from just under $300 per ounce to north of $1,500 per ounce. The GDM index we've used above rose nearly 8 times for the same period. I'll also mention that the widely followed Huey index for gold equities was up almost 14 times for the same period between 2001 and 2010. Since COVID, we have seen gold equities struggle against gold bullion. This was not because miners struggled to be profitable, but rather because we believe investors chose to ignore the miners. But it can only ignore value for so long, because through 2025, we have seen miners play catch up with gold in a big way. While gold is up 55% year to date, the GDM index has done a little bit better. It is up 120% year to date. We're starting to notice that various generalist funds around the world, particularly those in Australia and Canada, are rotating into mining equities, and particularly precious metal miners. We think that this move in gold equities is just getting started, and we are still very much in the early innings. Let's take a look at the gold miners compared to the S&P 500. We see that gold miners offer better valuations if you look at it from an EV to EBITDA basis. They have better profit margins, they have lower leverage compared to the S&P 500. And the one observation which I'll make here is that these estimates are based on using gold price, a forward gold price of $3,500 per ounce rather than $4,100 per ounce, which is kind of where it trades at right now. And this means that the valuations look even cheaper if you were to use spot metal prices rather than metal prices that are nearly $500-600 lower than the spot price of gold. Now let's begin our discussion on silver with a chart that will surprise many of you, just like the chart of gold surprised you as well. Silver has managed to outperform stocks and bonds through the 21st century. We all know that the path has been a little bit more volatile than that of gold. But the next slide here that we're going to get into talks about some very important trends that are underway, and there are strong tailwinds for the price of silver in the years ahead. And Steve was touching on a few of the other critical materials, and the word critical has been getting thrown around quite a bit of late. We have heard that critical being described for, or as a descriptor for copper, uranium, rare earths, and the likes. But we believe that silver is just as critical, particularly for high-tech applications. When you try searching for the best conductor of electricity known to man, silver comes up. I think it's little wonder that when we think of the best way to move electrons from one place to another, silver is front and center. It is used in semiconductor chips, 5G networks, power grids, and that's just a tiny, tiny example of its applications. What we need to pay attention to here is the graph on the bottom left. The world is using more silver than it consumes, and we do not expect that deficit to be resolved anytime soon. Econ 101 will teach you that when demand exceeds supply, prices tend to rise until the said deficit is eliminated. For this reason, and this simple reason alone, we think that silver should continue trading higher in the months and years ahead.
Thanks, Sri. So,
thank you, Sri. Speaking of critical materials, it's a good time now to turn it over to Justin to speak specifically about both uranium and copper. Justin?
Awesome. Thanks, Ed. I thought for this part of the talk, we'd start on this slide that shows the interlinking contribution of a whole bunch of different, critical raw materials to some of the themes that Steve was talking about. And I'm going to talk about copper and uranium today. Both metals are showing strength in their respective commodity prices that appears to be supported by good structural long-term factors. And we didn't choose these two by accident. We're definitely practicing what we preach here. The METL ETF that Steve's going to talk about later has over 20% exposure by weight to copper and 20% to uranium. And that's based on genuine metal production. Copper, you can see, is the second row here, and it's used right across the board in almost all aspects of energy demand. It's integral not just to power generation, transmission, but also construction, transportation, and so on. Uranium, in contrast, has just one dot under nuclear. But, don't be fooled. It's absolutely pivotal to providing clean, reliable baseload energy. And if baseload is not a term you're familiar with when we talk about energy, you should spend some time and get used to that concept, because it's key to the energy independence that Steve was alluding to earlier in the talk. What makes uranium so special is that, unlike most commodities, there is no substitution for it. There is no demand destruction price. If you're running a nuclear reactor, this is your fuel source. And both of these metals are increasingly seen as strategic, increasingly listed as critical by governments globally, and they're benefiting from rising demand. So let's jump into it. There's a lot going on in this graph. You can see a bunch of one set of supply-demand numbers and forecasts, but what you can see is the kind of, what is that, tan-colored inventories have basically evaporated the last few years. The black secondary supplies are decreasing sharply. The x-axis here has quite a long tail. It goes all the way out to 2050 or so to highlight the disparity. But if we were to move that more backward looking, what you'd see is that rise in uranium mine supplies from 2022 sort of heading up to now is currently failing to meet reactor requirements. You know, just this year, we've had the world's two major uranium miners out talking about challenges in bringing extra pounds to market. When we say challenges, it's everything from development bottlenecks, construction delays, sulfuric acid shortages, regulatory headwinds. You know, when I look at this slide, the thesis is really simple. You know, there's a uranium market which is structurally undersupplied. You've got utilities that have not yet returned to replacement level fuel buying. We can see demand's not just growing, it's accelerating with, you know, countries desirous for energy independence, the power-hungry tech sector that Steve had some slides on, decarbonizing power grids. So if we want to lift the supply side of this graph, the bad news for utilities is that uranium exploration has basically been on life support for much of the past decade and a half. We've had very few new greenfields discoveries, and if you want to bring a new uranium mine to market, in the best case, you're talking about a decade by the time you drill it out, permit it, construct it. And that's an aggressive timeline. You know, Sri alluded before to Econ 101. What any student will tell you here is that you need a price response, and we're starting to see that play out the last few years. So let's talk a little about some of these governments looking for energy autonomy. The US government, importantly, you know, with public and bipartisan support, has taken significant steps to encourage the expansion of its nuclear power, recently via executive orders. Nuclear is the single largest source of low-carbon power in the US. It's 16% of America's electricity generation. And today, that needs 47 million pounds of uranium every year. The goal is to grow that to almost 200 million pounds by 2050. Here's the issue. The US imports over 95% of the uranium it needs to fuel its, call it 100 reactors. And here and now, global production is heavily concentrated in non-Western jurisdictions. You know, a lot of non-French shored material. Over 40% of last year's uranium production was shipped through Russia. Most of that came through from Kazakhstan. But the US knows that it needs a stable domestic fuel supply to avoid bottlenecks. So you're seeing federal support via funding, via legislation, DOE pilot programs, companies moving to vertically integrate. And it's not just the US. we could look at Europe. Those countries that already have nuclear capacity are expanding. The WNA has the number of operational reactors for Europe at about 166 when I looked last, but there's another 55 either under construction or planned for construction. That's what, a third growth coming? And there's a bunch of countries which historically relied on other energy sources that are changing their legislation and their attitudes. So what does that mean for uranium and uranium miners? Everyone here is clever. You can see the outperformance the last few years in the U308 spot price and the equities. You know, our thesis is the nuclear renaissance is just getting started, and we're in the early stages of a sustained upcycle here. How that's expressing itself so far is the higher prices and the equity valuations have been sufficient to incent some mines which shut down at the bottom of the last cycle and have been on care and maintenance to turn back on. And these are trickling back in. That's that rise in mine supply that we saw sort of gently lifting up. But, you know, these mines were supported by existing permits and legacy infrastructure. That's kind of the limit of the easy pounds. Contracting still below replacement levels. And a lot of these companies bringing production back to market have yet to contract meaningful chunks of their pounds. And they're looking to benefit from that supply-demand imbalance. One other point, actually, while we're on this, which is perhaps obvious looking at the chart, and this will apply to a lot of what Sri said and a lot of what I've said and going to say. This is commodities. There is inherent volatility. It's your friend. You should expect and embrace some volatility. It's not uncommon in the midst of broader bull runs to have meaningful pullbacks. This is obviously where it's helpful to have a Sherpa to guide you through the investing landscape like Sprott, perhaps. Let's move to copper. Same as before, we'll talk a little about demand drivers, we'll talk a little about supply issues, and then we'll touch on how the copper price and the equities are responding. But rather than put up another sort of dull graph, I like this image with the big boxes. The increase in copper demand that you're seeing there, and they've chosen 2050, but you know, it could be anything. This is not new and it's not surprising for students of commodity history. Copper demand has doubled every 25 years or so since the early 1900s. It comes in waves, but whether it's the post-war build-out in the 60s, industrial and electronic expansion in the 80s, the Chinese industrial boom in the early 2000s. We flash forward to today, the drivers are different. We've got surging energy consumption from developing countries. We've got accelerating urbanization. We've got the rise of artificial intelligence and these power-hungry data centers, battery-bearing vehicles. It's coming, guys. But the takeaway here is when you've got a regular doubling in demand over regular time periods, that's not linear growth, that's exponential. So touching on supply, there's a couple of common themes here. You can see declining ore grades at the mines in the graph on the left over time. And that's compounded by the fact that new mines, especially new mines of scale, contributors, are generally speaking getting deeper and deeper underground, and they're increasingly located outside traditional Tier 1 jurisdictions. In essence, what this means is the cost to extract ore goes up, and it creates a higher hurdle rate for new copper projects. In the graph on the right, you can see the scarcity of new discoveries. And I can tell you, since 2010, there's been chronic underinvestment in what we call greenfields exploration, looking for new mines. As an industry, what we've done instead is, working through the bear market, operators squeezed the brownfields lemon harder and harder. They worked at their existing operations where they already had amortized the plant and the fixed infrastructure, and they leaned on those operations for more and more marginal ore. And that brings us back around to the declining head grades we were talking about. So what you've got is a supply problem. And once again, bringing on a new copper mine of scale has huge lead times. These are large CapEx investments. They've got relatively long paybacks. You know, in the US, it's pushing up against 2 decades to take a mine from construction to production. And then it takes years to ramp them up. So a quick supply response just isn't coming. Here and now today, we've just had the market tip into what's probably its most significant deficit in the last 2 decades. And just recently, we've seen big supply disruptions as large operations get taken offline. They get taken out of the market, some due to things like politics or civil unrest. And this comes back to what I was saying earlier about new mines are being increasingly pushed into frontier jurisdictions. Or we've seen mature operations have black swan events, some to do with seismicity or geotech or mud rushes. And this touches on the topic of the mines are getting deeper and deeper. And the operators manage it, but you know, these things happen. For perspective, the 2nd and the 5th largest copper mines have both had major interruptions this year. Last year, another top 10 copper mine was forced to close by its host country as it faced civil unrest. So I just saw Scotiabank recently revised its 2026 forecast for copper to a 380,000 tonne shortfall. By my measure, that's 4, 5 medium-sized copper mines. I sort of think of a medium-sized mine as 50 to 100,000 tonnes of copper annually, or 2 large copper mines that's needed to put back that shortfall. And in the short term, I just see where that's coming from. So what that's meant is copper prices have surged up sort of, well through $10,000 a tonne. I think there's been a little pullback today, but you can see the strength recently on that graph. This is up to Q3. They actually are through 10 here. And analysts have been scrambling to update their forecasts. Last I checked, the 12-month target price for copper's gone up an average of 15% the last few months. Worth talking for a second here. Last week was a great big annual event. The LME Week was held. This is the annual flagship event organized by the London Metal Exchange. It brings together all the stakeholders from across the supply chain. So smelters, financiers, traders, miners. BMO runs an anonymous poll each year among attendees. And on the question of which of the 6 LME base metals will outperform over the next 12 months, copper won by a landslide. I think it got 45% of the vote, more than twice whatever was next after that. So that brings us to the copper mining equities. And well, we should touch on the impact of M&A in this space. Last month, I think it was September 9, Anglo American and Teck, 2 of the big copper heavyweights, announced what amounted to a merger of equals to form a new global critical materials champion. It's a $53 billion deal, And it's the biggest copper mining transaction of the last decade. When they get together, if they get together, it'll make a top 5 global copper producer. There's some good synergies, there's some strategic rationale for it. But what it means is suddenly every other copper mining company out there has to look sideways at its peer space and ask the question, well, where do I sit in the pecking order now? And we think that's really interesting. We think there's a handful of companies out there with undemanding multiples, meaningful growth, and a track record of delivery. And like you can see on the graph, we think that equities, particularly in strong markets, are set to outperform. And maybe that's a good segue into our investment process here. So I'll throw it back to Ed for a sec.
Thank you, Justin. And yeah, that's spot on. I do want to dig into the active management side of metals and mining and really talk about why that matters and certainly why it matters to Sprott and how we believe we can add value for the investors that are tuning into this webcast. So, why don't we start, Shri, with you and talk about really the general Sprott active management advantage. Talk a bit about that, and then we'll open up the dialogue and open up the discussion from there.
Yeah, thanks for that, Ed. And I would say that at Sprott, we've been focused on building a process which is not just comprehensive, but is extremely repeatable. And the edge that we have built comes from decades and decades of investing experience that we have across the team. And what that really means is that we've seen a couple of different commodity cycles, at least a couple of different commodity cycles over our careers, if not more. And it just allows us to understand the here and now of the metals and mining universe. And we know how the value is created in this space, especially at different points in the cycle. We try to meet as many management teams as possible. In any given year, we'll have at least 200 management meetings. And this allows us to continue to build a strong relationship with these management teams that's built on familiarity, credibility. We also have make sure that our interests are aligned with each other. And finally, when it comes to numbers, we try to go as deep as possible. We're trying to understand whether the capital numbers for growth are credible. We're trying to understand the financing pathways that are available to the companies. We're always on top of sensitivities, be it from rising copper prices, rising gold prices, rising silver prices, or rising production costs sometimes. Inflation used to be a big deal for the industry back in 2022, 2023, for instance. And when it comes to active management, we don't just talk about being active, we try to live active management. We have a daily call. On these calls, we have spirited discussions where we challenge our thesis on various different companies, on various different sectors through different lenses, be it financial or technical. And this daily process of having that internal dialogue with multiple portfolio managers who have seen many different cycles, combined with the regular company updates that we receive, it just gives us the ability of turning all that information into conviction. And the conviction is not just built in front of our desktops. It also involves getting out there, getting the boots on the ground, and doing the due diligence that way as well.
Well, speaking of boots on the ground, Justin, you've got many stories you've shared with me on just that. Why don't you expand on that a bit and how important it is to have those boots on the ground and physically be at some of these mines?
Yeah, of course. We put a lot of emphasis on the importance of site visits. There's a lot of tangible and intangible benefits. What would I liken it to? You could sort of liken it to somebody trying to tell you about their restaurant. And they say, oh, we've got the best food, we've got the best location. It's the difference between talking about it and then going and eating there sometimes. It's where narrative runs right up against evidence. And there's lots of ways that we could talk about that and lots of things, but maybe the easiest way is to give you a couple of examples. Sometimes it's about soft stuff. Sometimes it's about culture. And, seeing a manager, seeing a CEO present gives you something, but it's not the same as spending a couple days on site, interacting with site teams, asking them questions, seeing how they respond to challenges. I remember going out to visit a precious metals project in West Australia, and we had to get up at 5 a.m. To get out to the little regional airport, and the CEO was there, and I'm going out on the same plane as all the fly-in, fly-out workers coming. And it's 5 a.m. All anybody wants is coffee, or maybe that's just me, but the CEO was out there. He knew everybody's name, and he's working up and down the line in the waiting room as we're boarding, saying hello to people, asking them about operations, about their families. That kind of interaction is a great insight that you wouldn't get otherwise. And those sorts of places are going to have very low turnover where people feel seen and valued. And you can't see that otherwise. Ultimately, Sri mentioned conviction. And, we can take our own experience and our own knowledge and turn up. I remember visiting a copper project in Latin America, and the interpretation was there's an underground mine sitting underneath an existing one that had been mined historically. And they had a sequence of stopes all laid out that they were going to go try and get. And I remember looking at the rocks on the surface and seeing, in geology we call them boudins, it's French for sausage, but little blobs that have been sort of stretched out. And there's one in the gap and then one in the gap. And I looked at their drill core and I was seeing an ore hit and a gap and an ore hit and a gap. And I looked at the old mine and sure enough, there was a stope and a gap and a stope and a gap. And that wasn't what was planned. So we had a different interpretation to management, which when they started mining it, turned out the ore wasn't all where they thought it would be, and they had some issues they had to work through that, we were able to come to our own conviction and work separately. One of the great things you can do with site visits is conviction sometimes comes from, being early on new discoveries is a great way to generate good returns. The issue is how do you know which discoveries are actually have legs and scale and will go on to be mines and which don't? Getting out early to sites lets you see potential synergies that are there, lets you get a feel for how companies are mitigating risk, lets you see how they're engaging with stakeholders and communities for things like social license. I could probably keep going on these, but let's leave it there in the interest of this. But I think for reference, these three images are maybe Morocco on the left with Maria. This is the Congo in the middle looking at drill core, and on the right is historic workings underground in Mexico. So we're doing our best to be proactive here and get conviction in our investments.
And Justin, maybe walk us through on this next slide that just popped up, what that looks like from an active management standpoint, how a portfolio ultimately comes to be, and how those weights look, and maybe give us a little insight into why we've chosen to go this route.
Yeah, this is a slide we put together on METL. It talks about the relative weights in the portfolio today. And you can see we've given ourselves a fair bit of wiggle room there, but what it reflects is that top-down thesis, looking at supply demand, looking at drivers, and Obviously, it also looks at the relative size of markets. It doesn't really matter how bullish you are on cobalt. It's a very, very small market, and if you wanted to go looking for it, you need to balance that risk weight. But simplistically, you can use this as a proxy for sort of where we're going to be. And then we'll blend that with a bottom-up approach where we look at the entire universe of companies and we'll identify the ones that we believe most strongly in, that we think have the best management teams, the best projects, the strongest growth, that are well-run businesses that are sustainable. And we'll marry those and build a portfolio from that. A word on these tiers, they can and you should expect them to change over time, not quarter to quarter, maybe not even year to year, but commodities as a sector do move in cycles. They've been unloved for an extended period now. We're seeing some life coming back into the space, but they don't all move together. There are leaders and there's laggards in that space. And some of this will be reflected as these weights gently change over time. So those of you who follow this METL progression will be able to see that in slow motion as it happens. These cycles take years to play out historically. I like this slide. This is let's talk about this. There's a lot going on here again, but what we've done is broke out returns in the commodity space into quartiles and then thrown up the average there across the years. And the takeaway, at least for me, average returns can be misleading. What you see here is a long positive tail for the statistical wonks here, where the top quartile adds most of the value. This is not unexpected, and it reflects statistical distributions that you see in nature and human sciences and a bunch of other things. And it turns out you see it in mining stocks. And this is one area where good active management can really shine. Based on our research, we're able to overweight our highest conviction investment ideas. And the inverse is also true. You can underweight things that you have more trepidation about. And that results in substantially different exposures relative to passive indices. The goal is always the same. It's to identify and exploit alpha while maintaining exposure to underlying beta. Another interesting wrinkle on active management, not just the returns, but the ability that Sri and I and the other PMs have to take steps to proactively manage volatility, which we talked about before, and risk. We're always working to try to, manage volatility, minimize beta and drawdown. Oh, this is our segue slide. I think we're going to throw to Steve shortly, but I like these because these are the images of the NASDAQ congratulatory tower shots on the two ETFs we'll talk about, METL and GBUG. But, what I want to talk about is always the things that make it up. When you see one of these big electronic billboards, you've got steel and aluminium as a structural metal to hold up the LED panels. Copper is there as the conductor on circuit boards. You need gold for the bonding wires on LED chips. Silver's there for, like Sri mentioned, conductivity. They also put it in layering to improve brightness. And then we get into rare earth phosphors for the LEDs and indium for color tuning. But I think the takeaway is these are real things. We can go out and touch them, and they're essential and increasingly essential in our modern world. All right, I'll stop it.
Well, that's a perfect segue into bringing it back to Steve. And Steve, I just want to highlight sort of the two newer ETFs that we've rolled out, the Sprott Active Metals and Miners ETF, METL, and then also talk a bit about the Sprott Active Gold and Silver Miners ETF, GBUG, and talk what's unique about those. We've heard from the analyst team, the PM team, as far as how we add value from an active standpoint, but talk specifically about these two funds, and then we'll turn it back to Natalie before we open it up for Q&A.
Sounds good. Thanks, Ed. Yeah, these are two strategies that we're very excited about. The Sprott Active Metals and Miners ETF, ticker METL, or METL as we've taken to call it, launched last month, has gathered about 35 million in assets already. This is a strategy that's the first of its kind. It's an actively managed, diversified metals ETF. And when we say metals, we're talking mostly about mined metals. If we were to think back through that tiering slide that Justin went through, this fund will provide exposure to many critical materials, things like rare earths, silver, copper, battery metals. Uranium is also included in here, as well as steel and platinum group metals. It does have a wider mandate where it can also provide exposure to miners of gold, zinc, and aluminum as well. So this is a strategy which is meant to be, critical materials plus other aspects of the metals market that are needed to build out this infrastructure that we see. It's really unique in that it's the only ETF out there to provide this active exposure. It's drawing on, the experience of our investment team, which has, many decades of experience in this space. And as the first of its kind, we're excited to see, in the first month and a half or so, how it's been received out of the gate. I've seen some questions come in asking about K1s. All of our ETFs are 40 Act ETFs. Metal is, dedicated to mining equity, so there is no K1 involved in either Metal, GBUG, or any of our other U.S. listed ETFs. Looking at the makeup, we won't spend too much time on this slide so we can leave some time for questions, but you can see on the top right, country of domicile, largely allocated to Canada, United States, Australia. The goal here is to provide the investment team with flexibility for this mandate. To the extent that they want to invest in countries not listed here, they have the flexibility to do that. I will say across our U.S. listed ETFs, we don't have exposure to China A shares, so mainland China. One of the reasons that we don't provide that is because we think a lot of this growth is going to come through the U.S. and its allies as countries look to secure the supply chain. We also have a breakdown in the materials weighting, similar to what we saw in the tiering structure, weighted to copper, uranium, and silver at the top, and also significant exposure to rare earths. Currently holds 36 different companies. We'll just pause for 1 second here on the performance as we move on to talk about GBUG. GBUG launched back in, this is our active gold and silver miners ETF. This launched back in February, now has about 130 million in assets. It's another first of its kind in that, there are no other actively managed metals ETFs or mining ETFs out there that are focused on providing gold and silver exposure. So with this, you'll see it's somewhere around 90% gold, and the rest is mostly invested in silver. Again, drawing on the same investment team that we have here with the addition of John Hathaway. Combined, this investment team has over a century worth of experience in this space. So it follows a similar investment process that we see on metal, which Justin and Sri went through. So very similar process, up to 30 site visits a year globally, not staying within U.S. borders, but really going out and about. And I think the number is somewhere around 40 different countries that the investment team has been to at mine sites. Very, heavily weighted to silver and gold. Again, this is one of those funds that we wanted to bring to market. We do have some passive gold miners out there as well, but we have found that some investors do prefer active management in the gold space. And we wanted to provide this for investors that are comfortable taking on that active manager risk. And here's just a quick snapshot of the performance since its February launch. One of the questions, and I'll mention also that GBUG also does not have a K1, being that is a 40 Act ETF. One of the questions that we often get asked is how do these two funds fit into a portfolio? If we look at GBUGs, some will use it as precious metals exposure because you get some operating leverage to the underlying precious metals. You could dial up or dial down some precious metals exposure with that. Generally, we see investors allocate either through commodities or in a lot of cases, particularly in metals case, where the long-term supply and demand dynamics tend to favor growth orientation. We see investors may add that to a thematic sleeve within a well-diversified portfolio in the hopes of capturing some growth. And just before I kick it back over to Ed to move on to the Q&A section, just wanted to provide a snapshot of all the ETFs that we have, all dedicated to critical materials and precious metals. One thing that really sets Sprott apart as it relates to our ETF offering is we are able to develop a lot of these indexes. If you look at all the critical materials ETFs as well as SLVR, these are all indexes that we've developed with NASDAQ. So we have a very active role in bringing our expertise and bringing that into the methodology of the underlying index. Twice a year, we'll actually go through a process where we'll look at all the mining equities globally, and we'll go through and we'll assign an intensity score to each individual equity. And basically what that score is, it's just a way that we're saying, this company has X percent of their revenue or assets dedicated to silver or copper. That becomes increasingly important when you start looking at some of these different metals. Silver is a great example, SLVR, the Sprott physical silver, or the Sprott silver miners and physical silver ETF has a dedicated physical silver allocation. But within that, it has a pure play focus to miners. That pure play focus, again, is we're looking predominantly for those companies that have at least 50% of revenue or assets tied to the mining or exploration of silver. Silver, that becomes increasingly important because the majority of silver is mined as a byproduct metal. So from mining lead or copper or zinc or other metals, what you look at is if you take the 10 largest silver producers globally, 0 of them are predominantly silver miners. And this is where a ticker like SLVR, while it's still a passive strategy, kind of has a little bit of a more of an active feel to it because we've taken the time up front to actually go through and build what we believe to be a very quality index that is really going through to identify those pure play miners. Happy to talk about after this call with anyone, about any of these ETFs as our sales team. And I would just say head over to SprottETFs.com if you have a few minutes to learn more about these funds. We also have a lot of great insights coming from folks like Sheree and Justin out there talking through a lot of these different themes. So Ed, I'll kick it back to you.
Great, thank you, Steve, and thank you all for joining the webcast today. I know we're close to the top of the hour, but I do want to address a couple of the reoccurring questions that are coming in, and also remind everybody that we will be following up with all the questions that we've received today, whether it's through email and or phone call. And also please reach out to us for further questions or copies of today's presentation deck. But before we go into the Q&A, I would like to turn it back over to Natalie for one moment, and then we'll go live on the questions.
Wonderful. And thank you all for such an informative discussion. Just as a reminder, material can be found in the documents folder to the right of your screen. We appreciate your feedback. Please take a moment to fill out our brief survey that is also located at the bottom of your screen. Our speakers will be taking advisor questions. Please type your question in the box underneath the slides, and we'll do our best to go to as many of your questions as possible. In the event your question is not answered on today's webcast, a member of the Sprott team will reach out to you directly. And if you'd like to have a conversation to further discuss the ideas that were covered during today's event, please click the confirm button in the meeting request box on your screen. So with that, Ed, I will turn it back over to you for Q&A.
Thank you, Natalie. And the one of the reoccurring questions that keep coming up is about the market movements, really on Friday, and then yesterday on the positive side and today on the negative side. So Justin and Sheree, I'd like for you both to kind of address this, and what are your thoughts on the most recent market volatility we've seen, and just the last couple of days? Is it technical? Is it profit taking? What's happening out there? Sheree, why don't we start with you? What have you seen in the last couple of days, and what has history told you when these types of moves happen?
So I'm assuming we're specifically touching on gold and silver. Is that correct, Ed?
Yeah, well, the uranium's in there as well, but why don't we start with gold and silver, and then I'll kick it over to Justin to talk specifically about what's going on in uranium.
So as it relates to gold and it kind of dovetails into silver as well, we have seen a massive run up in the price of both of these metals for the entirety of 2025. As I've spoken to earlier, the price of gold was up north of 55% year to date. Silver is close to 70% year to date. And we had not really seen a meaningful correction in quite a bit of time. So this I think is just a little bit of steam coming out of it, which I think is perhaps anticipated by many for a long time and has not come as soon as many other people had thought it was going to come. But this particular, I would say, just from a technical perspective, it's long overdue, and it's a welcome pause, and it just kind of will reassert, I think, back to the upside once it takes a little bit of time to consolidate, take a breather. I would also note that from a statistical point of view, the move we are seeing in gold down 5.4% today, silver 7.2% today, is very, very big. I think it's 4 standard deviations, which is extremely, extremely rare. And we typically tend to get a bit of a mean reversion back. And I think that the underlying strength in the price of gold and silver has not gone away, has not dissipated. Some of these big moves we have seen flows coming into the ETFs, maybe they take a breather, like I said. But fundamentally, this is not much to be concerned for.
Thank you. And Justin, anything to add to that? And I guess specifically on the critical material side, any additional insight to add? You may be on mute, Justin.
Yeah, thank you. Sorry, I'll take myself off mute. But not just on the critical material side, but generally speaking, we can spend a lot of energy and hot air talking about, moves over the last 24, 48 hours since the weekend. And it brings us back around to the importance of building up your own case and having conviction in your thesis on a given metal and a given company that you're going to own. And a day-to-day move, it can whipsaw you around, or it can feel like you're stuck in quicksand trying to trade your way out of it. But this is why we like to take a slightly longer-term approach. And, as new executive orders or deals are signed on different commodities, there will be winners and losers in the space on individual names. And we're able to react to these on a bespoke basis. But I try not to feel too clever when things go up strong in a day, and I try not to feel too despondent when they go down. I'm more focused in the medium and longer term. And, we use these as opportunities. We talked about volatility before and the idea that it can be your friend if you plan for it.
Well, let's stay on that for a moment. One of the questions that keeps coming up also is the history of mining companies. I think this question is specific to really gold mining companies. So again, maybe you and Sri can address this, but the question is, gold mining equities have a poor reputation of misallocation of capital and mistiming from a company management standpoint. What has changed, or has anything changed? Why don't we stay with you for a second, Justin, and what have you seen in this cycle compared to, say, the 2000 to 2011 cycle? What's different or what's changed today?
Yeah. That's a really, really important question, and it's very relevant. Last month was the big precious metal mining conferences for North America. We all get together in Colorado and spend a week or so. All the big players are there, all the banks, everyone. And, you're right. The excesses of the last bull market, which, the seeds for their own destruction, were sown in the concept of growth for the sake of growth. The idea that bigger is better, irrespective of quality. We've been on the warpath, especially the last few years with issuers, to try to avoid that, with the mantra that gold companies aren't competing with each other. They're competing with every other business out there in the S&P. And if they want to be treated the same, they have to act like real growing-up companies. And that means focusing on things like return on invested capital, per-share metrics. And I can tell you, overwhelmingly, the message we got back from issuers was, and it wasn't just coming from us, I presume, but that's being received. We're seeing discipline. We're seeing them talk about using the strong margins they've got now from the rapidly appreciating gold price to invest back in the business, sure, but also return capital to shareholders where there's excess through share buybacks and dividends. We're not seeing crazy mergers and acquisitions where there's no synergies. People paying big premiums for something to go into a new jurisdiction. That's the exception, not the rule. Instead, we're seeing very measured, synergistic M&A with clear returns on capital. And so far, they're walking the walk. There are the heady excesses, the idea of producers issuing large amounts of shares to go grab something shiny. It hasn't come around yet, which gives us faith that we're nowhere near the top of this current cycle.
And Sri, would you like to add anything to that as relates to the market and kind of good versus bad behaviors?
Yeah, so a couple of points I would add to that is we touched on the valuation of the precious metal sector, and it does apply to the copper miners, uranium miners alike, in that some of these valuations that we find for the mining companies are far removed from what we saw during the bull market. And when you have a company that is trading at an exceptionally inflated value, you are creating a recipe for that company to go and do something silly with this paper. And right now, most of these companies don't have the capital to be able to do any of these silly behaviors like bad M&A, trying to go and start up an ill-advised project, for instance. So by and large, we're seeing companies stick to their knitting and try and demonstrate to the broader market that we are being good businesses first. We're trying to demonstrate free cash flow. We're trying to demonstrate return of capital back to investors, be it through dividends, be it through buybacks, etc. And the proof is in the pudding. You can see that we had a slide up for the annual gold production. Over the past 4 or 5 years, it's actually more like a decade. The annual gold production has not really shifted anywhere. It's just gone sideways because there has not been a huge amount of capital spent on building these giant mines. So I think that there's good reason to believe that the mining companies have taken advice from their investors that they need to be mindful of how they conduct their business of mining.
Thank you. And I know we're almost 10 minutes over our allotted time. We've got north of 50 plus questions here. So we're not going to go through all the questions obviously right now, but maybe we'll end with one that seems to be popping up a lot also. And I'm going to lump two questions together and maybe just do a quick speed round on the Fed and interest rates. That's one question. And the second one is on tariffs. How real is that versus perceived, perception versus reality on tariffs? So let's start with the Fed. Sri, let's stick with you. What do you think the Fed's going to do? And will, if rates go down, will that help or hurt the general metals market?
I think the overarching thing to keep in mind here, and this was on slide number 12, the rate of increase of the government debt has been stupendous. It is the rate of debt increases has been faster than the S&P 500 over the same period of time, I think since 2000, I would say. And if you have lower interest rates, that just means that we'll probably start to continue seeing that debt continue to increase higher, which in turn means that the pet rock, the barbarous relic, whatever you want to call gold, becomes more and more attractive for people who want to maintain it as a store of value. And I think on slide number 11, we had talked about how well gold has done relative to the various different equity as well as bond benchmark. If rates go lower and debts continue to stay high or keep rising, those are all good noises as far as gold is concerned, as far as silver is concerned. And I think it probably applies for pretty much anything you can drop on your foot and hurt yourself.
Perfect. That's a good end to that. And Justin, I want to finish with you and talk briefly about tariffs. You talked a lot about site visits and meeting with CEOs and mine visits and stuff. What's the general feel out there with what's going on with tariffs? What are you experiencing as you talk to these CEOs and go visit these sites?
It depends, I think, is the answer. But intuitively, I think everyone understands as you put up barriers to entry for certain products, we know what you're trying to do is stimulate domestic supply, increase friend-shoring, which was a phrase Steve mentioned earlier. But what happens is you're just creating globally more nodes to move things around, to take a product from point A to point B, or to take a material to a finished product or something like that. More nodes, adds a lot more complexity. I'm not sure if it's exponential, but it's probably, adding that sort of block where you can't have simplistic movement means more complexity. And ultimately what that means is more opportunities for people who have gone out there and done the work and understand the landscape and understand where in the vertical value adding ladder, who are the customers, where can it get to, who will the beneficiaries, and who will, will be the winners and who will be the losers. And I mean, that's kind of what we wake up every morning and come into the office for, right? So there's swings and there's roundabouts, there's winners and there's losers, and we're doing our best to try to be as proactive as we can on that in the turbulent times we find ourselves in.
Well, certainly as active managers, you guys have your hands full. So thank you for that. And thank you for sticking around for an extra 12 minutes or so over our allotted time. On page 44 of the slide deck, for those that are still with us on the webcast, any further questions you have, I encourage you to reach out to Matt Harrison and Sergio Lujan on the different territories you see on the map here. But also you can certainly reach out to me as well. There's my phone number and my email address, and we'll make sure we address all the questions from today's webcast. So thank you again for listening to our webcast today, and thank you for your interest in Sprott.
Great. And thank you all for such an informative discussion. As a reminder, material has been made available for download. That can be found in the documents folder to the right of your screen. We appreciate your feedback. Please take a moment to fill out our brief survey, also located at the bottom of your screen. As mentioned, if your question was not answered on today's webcast, a member of the Sprott team will reach out to you directly. And if you would like to have a conversation to further discuss the ideas that were covered during today's event, please click the confirm button in the meeting request box on your screen. Thank you for joining us today, and enjoy the rest of your day.